Hello, everyone. Welcome to BackNine's webinar, The Value of Long-Term Care Expense Planning, and keeping within the fact that it's Long-Term Care Awareness Month. I'm so happy that we're able to offer you another solution to long-term care planning. I'm Ilana Fox. I am the Long-Term Care Brokerage Director here at BackNine, where we work hard at offering you simple and easy ways to insure your clients. I have been in the long-term care solution planning market for over 15 years, and what has remained constant is that it keeps changing. So it's my job to present to all of you the various solutions available. Carriers know that long-term care is a real risk, and they need to be accountable for it. So what I am looking forward to do this morning is to share with you what I have learned in our long-term care insurance world, sharing with you very plausible answers to your clients' needs and concerns. Our guest this morning is Lee Superville, external MoneyGuard specialist from Lincoln Financial Distributors. MoneyGuard offers a fantastic solution for long-term care coverage, offering guaranteed usage or your premium back if you choose to do so. But before we get started with Lee, I would like to start out with a little bit from BackNine, giving you an insight into our culture here at BackNine. It's starting.
So you're saying I can ask this cat any question? The cat is connected to the computer. You just type in the question. It will reply. You're the man! I've been looking for this for weeks.
Okay, that's what we're here for. We're here to help you simplify and get the best answers for you and your clients. In fact, next week, Tuesday, at 9 o'clock Pacific time, we will be presenting a webinar on an overview of our back office, professor and cat included. Okay. So let's move on and learn about MoneyGuard and Lincoln Financial. Everybody will be on mute. If you have a question, please type it in, and I will be able to ask Lee your question. So Lee, it's all yours. Tell us all about MoneyGuard and Lincoln Financial.
Excuse me. Excellent, Lana. Thank you very much for that introductory video and a little bit more about BackNine. Again, my name is Lee Superville with Lincoln Financial Group, and specifically like the MoneyGuard division. I'm their external MoneyGuard specialist. So I'm very proud to be here today. It's an honor getting a chance to work with BackNine. They have a lot of solutions for you. They're a great contact to make sure that the client that you're talking to has the right fit for anything when it comes to wealth protection and especially long-term care planning. And that's why we're here today. This month, November, is Long-Term Care Awareness Month, which is Alana already stated. So there's a lot of information going around long-term care education and making sure that clients know all the options that are out there. And this is really what we're going to focus on the webinar today. So essentially what we're going to go over is pretty simple. I have a handout for you here that we'll walk through that essentially goes over just the different options that a client has for long-term care. And that's specifically changed over the course of the last 10 years or so. We're not in the same environment as we were before, where traditional long-term care was really that sole option for focus protection when it comes to long-term care. There's actually more options that are out there for a client based on their need and based on their priority that they can dive into. In fact, over the last 3 years, what we've learned here over the carriers is that over 500 new solutions have entered our network. And that's all specific long-term care solutions. So it's quite a bit. There's a lot out there. But when you look at all the carriers and all the different products that have emerged over the last couple of years, that does make sense. But essentially what's going on there is that clients are looking for areas for more education around these different options. Advisors are doing the same way, are doing the same thing. So this presentation will kind of show you at least some of the different options that you have. And then at the end, we'll touch into one specific option, which is in the hybrid channel, which is a linked benefit for life insurance and long-term care, giving you guaranteed benefits, a return of premium option, and also, of course, a life insurance option or a death benefit for your clients, which is called MoneyGuard. But we'll get into that in just a little bit here. So if you actually look at the slide that you have in front of you, this is something that Lincoln has come out with just to go over some of the options as far as planning for long-term care expenses. Obviously, it's something that a lot of clients are facing, and they want to make sure that they're finding the correct option for them. So right now, there actually are 5 areas where a client can dive into based on the type of care coverage you're looking for long-term care, and of course their priority when it comes to a carrier solution. Now the one that they're probably more familiar with is traditional long-term care, but the range does go farther than that. You have the hybrid or the linked benefit products. You have the life insurance with the ABR riders or LTC riders. You also have the annuity with the long-term care rider on there as well, giving them a little bit more bang for their buck when it comes to meeting long-term care. And then, of course, self-insuring. Now, one thing I do want to touch on with self-insuring that's important to note is that a lot of clients out there are comfortable with the myth that if they save enough money and they concentrate on their wealth and they put enough away into the bank, essentially they can cover themselves for long-term care. Essentially, they can save up enough money and they'll be okay if long-term care were to arise. They like the flexibility, the control, and the options that they have with self-insuring. So, matter of fact, close to about 93% of the American population is self-insuring in some form or fashion, either saving up money, putting into CDs, or maybe money markets. One of the scary things that we know is that we're in a low interest rate environment, so that money isn't growing nearly as fast as it should, closer to maybe 1% if they're lucky. The long-term care is actually growing closer to 6 to 8% every year. So even though nursing homes today cost a little over $100,000, at least in the state of California, we also see that costs for nursing homes in different states are even higher than that. For example, in Massachusetts, we're actually seeing nursing homes cost closer to $130,000 a year. If we look at the rate increase of 6 to 8% over the course of 15 years, those numbers on a national average, that is actually going to get closer to about $265,000 a year. So you can see obviously how that can drain an individual's retirement plan money, especially if they're on fixed income. But really the reality as far as self-insuring or self-funding is in regards to is that this is not a guaranteed approach to long-term care. Unexpected costs might arise, and if they are looking at an expense that might cost them $13,000, $14,000 a month, they're going to be draining down their assets 2 to 3 times faster than they would like. For example, if you're looking at just a registered nurse, if you have had a nurse come to your house, right now those that are clinically proven, especially Medicare approved, nurses cost closer to $70 or $80 an hour. So that can actually equate to close to $13,000 or $14,000 a month. So you can see how that can obviously add up very quickly. So those are expenses that a lot more clients need to consider. So they need to look for a guaranteed plan, and we'll go over the 4 guaranteed plans for you in just a bit here. But of course, very important to remember that with a lot of the hybrid solutions, especially with MoneyGuard, they can also get extra benefits like tax advantages, tax-free advantages, and of course care coordination. as well, just to make sure that that claims process is easier. They get more money for their product, and obviously it leaves with a situation that's a little more carefree than if they had to do everything on their own. So we jump to the next slide here. We go over all the different options that we looked at on the first page. So we're going to start from the top and go down to the bottom, and looking at just what that strategy is, how the options look as far as if it wants to be a legacy, is the flexibility there, what's the LTC leverage look like, and of course the expense coverage. And then we'll look at some of the considerations, and that'll give you a better idea as far as, what are the pros and cons between each option that a client has today in the long-term care environment. So for the first one, we have traditional long-term care insurance. Really the priority for the client here is all long-term care. Essentially, they really want to get a policy that's just going to give them the most leverage for long-term care with a smaller premium. The only drawback, or one of the bigger drawbacks, I should say, with traditional long-term care is that it does give you great leverage for long-term care. However, if you don't need that benefit, if you are lucky enough to not need long-term care, all those premiums that you put into it can be wasted. So if you're paying for traditional long-term care for over 30 years or so, that premium can add up and obviously be a very expensive approach for clients, even though it starts off with a lower premium that might look quite attractive to them. Now again, there's not much flexibility with traditional long-term care. The big focal point there is going to be the leverage, and there's really no legacy built into the solution. There's no death benefit per se. So that's an important thing to keep in mind. When you look at traditional long-term care, you also might have some elimination periods to deal with. So you have to talk to a client that says, well, if you do have traditional, you might have to pay out of pocket before you have access to those benefits in the policy. You also have full underwriting with traditional long-term care. So they will have to have either a paramed, or they have to look at medical records, go to the doctor, blood and urine samples, the whole 9 yards, to make sure that they can apply and be eligible, at least for the coverage, and get that policy in force. But one of the biggest cons I've heard about traditional long-term care is really just in the premium itself, and the fact that it's not guaranteed. So you probably already heard about this before, but over the past 3 to 5 years, we've been seeing more rate increases for traditional long-term care than ever. So essentially, a client's going out and they're looking at the mail they're getting. They open up a letter and it says that their premiums are going up at 30, 40, or 50%. I've even seen higher than that, unfortunately. But essentially what that says is they have to shell out more money a month or more money a year to be able to keep the same benefits that they have, or the benefits drop. So that changes their long-term care plan, and they really don't know exactly what type of benefit they're going to get if they do need long-term care. So it can seem like a very low expense approach at first. The premiums are smaller with traditional long-term care, but over time that can add up and be a very expensive solution. And of course the premiums aren't guaranteed, so they might be paying more into it than they started. But the good point is that it is a focus on long-term care. It'll probably give you the most long-term care leverage out of all the 5 solutions. If we go down to this next option here, we're looking at the life insurance plus the long-term care combo products. So this is like the hybrid channel a lot of people will call, or link benefit, you might hear it referred to. Really the priority that the client's looking at here is that they're protecting their wealth from long-term care expenses while keeping the option to repurpose some of the benefits for legacy. So for example, life insurance. So really looking at this type of product, they have quite a bit of flexibility, because they can use it for long-term care if they need it, or they can use it for a death benefit if they don't. Both those benefits that come out are tax-free, so they get advantages there as well. And then some of the solutions do have a return of premium, like MoneyGuard, so they can have more liquidity with their options. Some of the other benefits are with the underwriting, because you'll see most of those products do have streamlined underwriting, which means that there's no medical records reviewed whatsoever. No one's going to come to their house and they're not going to have a pyramid done. No blood and urine samples. Essentially, really, they just do a phone call with a registered nurse after a prescription drug check, And all that information that goes to the phone call goes into the decision. So it's a very easy process. It's also an easier product to understand. And the great part about it is that it's all guaranteed benefits. So very different from traditional long-term care, but you're guaranteed to keep those long-term care benefits. In other words, as soon as that policy goes into force, all those projected benefits are set in stone. And that's going to be great for a client conversation because it's going to make it very positive as far as what their long-term care looks like, and that won't change. Also just using the flexibility of the policy for long-term care if they need it, and a death benefit if they don't. It does keep it a very positive conversation as well, because you don't have to necessarily focus on, well, you're going to need long-term care, and we need to give you a plan for that need. But instead, it's really a wealth protection strategy, saying that whatever happens in the future, whether you get sick or you do pass away, we're going to give you tax advantage money to take care of whatever happens, whether it's long-term care or a death benefit. So they can pass on that life insurance to the best beneficiary of their choosing while having that legacy protection built right in there. On top of that, you do have international benefits, usually with some of these hybrid or linked benefit products, and also inflation protection options. So I told you about how long-term care is growing close to 6 to 8% depending on the state. Putting on inflation protection is crucial. With MoneyGuard, you do have a 3%, a 5% option. We'll go more into this in a little bit. But having that inflation protection option built in gives you peace of mind that at least your policy is growing along with the rising costs in long-term care, so you can hedge that quite a bit. Okay, so we go to the third option, go down one more. We're looking at this life insurance with the ABR riders, which stands for Accelerated Benefit Rider. This is a great option if a client's priority is really to leave them behind a legacy and protect some of their loved ones. So again, they can name beneficiaries of their choosing. And the plan really is built in there to protect that legacy, but also with some optional protection if they need some for long-term care. So the focal point, again, is really a death benefit. So if the client wants a death benefit, they want to get the most or the biggest bang for their buck for a death benefit, they want to go with this life insurance with the ABR rider. It does have robust legacy protection in there. The death benefit number is quite high. But the idea is that with these type of policies, you can either get indemnity or reimbursement style to get your money back. So it may not have exactly the same leverage as the past two products in long-term care, but it does have a safe switch, if you will, in there to give you a little bit more if long-term care is in your future. But it's usually all based off of permanent conditions. So whether you get that indemnity or reimbursement style back, it's all based on permanent conditions. So something that you are diagnosed with, which obviously will probably lead to some sort of death. Some of the other names for these riders are going to be critical illness, chronic illness, or terminal illness. So you might have heard of some of those. So that's basically in the same category. So the idea there is obviously accelerate the death benefit so you can have some of that for long-term care expenses. A little bit more on indemnity and reimbursement, just so we can cover that. Of course, indemnity style is basically going to be giving you money every month based on a percentage of that death benefit, or you can get a lump sum, depending on your option. One of the things to consider here with indemnity is that anything above the per diem limit that a client might be getting can be taxable. So you want to obviously look into that. Also with indemnity, what we've been seeing is a lot of elderly abuse with how the money is being used. So instead of it going right to a long-term care need, indemnity obviously is a check that's going to be sent to the owner of that policy, whoever that might be. And there can be a situation where it might not be used directly for long-term care. So that's always a situation that you want to go over, and you want to make sure that there is not only a power of attorney, but obviously someone that can make sure that money is being used wisely.
You know, Lee, that's a really good point. You know, often I get clients that say to me, I want to have cash. I want to have the flexibility of doing whatever I want. I don't want to have to turn in receipts. but they did open how vulnerable they will be when they're really not in control of maybe cognitively impaired or, family issues. So that was a great point about there are pros with indemnity and then there are cons. So that was great. Thanks for sharing that.
Oh, of course, and it is a really great point and something to go over with the client so they know exactly what indemnity means. But there obviously can be good pros there and some bad cons, so just something to consider. And then with reimbursement, that is going to be where you are sending in receipts or filling out a form just to make sure that that long-term care, that specific long-term care expense is being paid for. A lot of times with reimbursement, you can actually do a reassignment of benefit where they can actually pay the nursing home directly, cutting out the middleman and making things a little easier for the client. But you do have to remember that a form will have to be filled out or receipts will have to be given before reimbursement is sent in. For anything for like home health care where there might not be a receipt, they can still reimburse things like that. But obviously there won't be that need to send in a receipt. Instead, you'll have to send in a nominal value and the reasons for the expense to get reimbursed. So it'll be able to cover you there as well. So that's a little bit more on indemnity and reimbursement, both good options. But again, both with the pros and cons. So it's good to go over that with the client to make sure that they're getting what they want in that long-term care plan. The next option here, we go down to number 4. We have the lifetime annuity with long-term care rider or a related rider in there. So this priority that the client has for the LTC rider on the annuity is really just having enough income to last their lifetime. So more people are actually living longer. We know that the average age that individuals live to is stretching out longer and longer. One of the biggest concerns that clients have is just having money until they pass away, so they can obviously maintain their lifestyle. So they do look for some products with guaranteed income. This one does have some flexibility to address some of the long-term care expenses that might arise. Again, there can be a death benefit built in, but it's not a focal point for it. There is some flexibility because you have the option to use it just to get monthly income, or you can get a little bit more if you do have a long-term care need. But there is good leverage there, and of course the expense coverage, or LTC expense coverage, is quite strong. So really the idea there is that usually these annuities are going to build up at a certain percentage, for example 5%. So your money will obviously grow tax deferred. When you start taking the distributions from it, you can take it on a monthly basis. But for example, if you go into a nursing home, they might increase that distribution, say from 5% to 10%, so you get a little bit more money for that long-term care need. The only concern here that you may want to address is that it usually doesn't cover all long-term care related needs. So it might cover a nursing home. Most of them have what's called actually a nursing home rider on there. So we'll cover any expense in a nursing home. But outside of a nursing home, it may not be able to cover that. So it's good to go over exactly what the definitions are in that LTC rider for annuity to make sure that covers all the options that clients are looking for in their long-term care plan. And again, with this one, you have the indemnity style, similar to any annuity, sending your monthly payments or annual payments that you're looking for. But a great option for clients, again, really focus on income. So they're just looking for income in retirement. Looking to pay for general expenses, but maybe a little bit more if they need long-term care. The last option we went over a little bit already on the last slide, so don't spend too much time on this, but this is going to be self-funding or self-insuring, and this is probably something that everyone's a little familiar with because we've been doing this obviously since we were young, and this is probably something that most clients are familiar with as well and probably more comfortable with. I shared with you obviously how the myth goes. Most clients like to self-insure and they want to try to save up as much money, hoard as much money as possible, so if long-term care does arise, they can just use that. But there's more tax advantage ways to saving up for long-term care. There's more of a guaranteed way to save up for long-term care as well. And there's a lot of advantages with having some of these LTC solutions that we just talked about because of the extra benefits for example, like care coordination. So you won't get any of that with self-funding, but really if their priority is just access to their money, that's kind of the big deal there. So liquidating funds from like investments in their portfolio, for example, if they need long-term care, cashing in their CD, going into their bank and writing a check, those sort of things are what the strategy is going to be for self-insuring. But I shared with you, obviously, interest rates are very low. A lot of the vehicles that they're holding money in, they are going to have to pay taxes on before they take it out. So it could be anything as little as a CD to an investment. And with the rates that we're looking at for short and long-term capital gains, that's something else that they'd have to consider down the road. But self-insuring does have great control of their assets. Again, easy access to their money, flexibility because they can really use it for whatever they wish. There's plenty of options as far as what they'd like to do with that cash. And obviously, if that is protecting their family, or maybe they want to pass it on as a legacy or gift it to kids, that's something they can do. But again, the big hurdle there is paying taxes. So you want to make sure that if that's something that they're comfortable with, that they know a lot of the tax implications that come with that, depending on what type of asset they're looking to liquidate. So those are just 5 options that we went over. And right now in the LTC environment, those are really only the ones that the client has to choose from. Within each area, though, there's obviously a lot of different options that they can run with, a lot of different products, a lot of different solutions that they can consider to make sure that they have the right one to protect their entire portfolio. And that's really the name of the game, just making sure that based on their priority, that they have the right strategy to make sure that all their wealth is protected. They're not losing any money frivolously. But again, there's a lot of things to consider. We went over a lot in a short period of time. But what we'll do next is we'll actually focus on this life insurance and long-term care like combo product area, or the hybrid market or linked benefit area, and just kind of talk about a little bit how MoneyGuard works, and that will give you an idea of what is really in store for a client, and really what they can count on as far as like how that solution really works. But in a nutshell, and I'll go over a little bit how MoneyGuard works while I pull out this slide for you. But essentially, in a nutshell, MoneyGuard itself is, again, just going to be a very big focus for long-term care, basically when the client needs it. If they do need it, they're going to get this reimbursement for the long-term care, which is going to be a great advantage for them. Now, if they don't need that long-term care, they're obviously going to have a good tax advantage with that death benefit that's built in as well. And then last but not least, they still have that return of premium. So they have 3 great options, all guaranteed for them, depending on what their future is, whether they get sick, whether they die, or they just decide to quit and they do want their money back.
Lee, let me interrupt for a second. We are looking at your computer right now. Did you want that?
Nope. Actually, let me see here. I'm trying to switch over to the next one.
See
if that's
let's see. There we go. Wait.
How does that work? Oh, I might have went back to the last one here. Hold on. Let's see here. Let's see if I can.
I'll get Jonathan on this. Are we good?
Let's see here.
Okay.
All right. How does that look?
No?
We're good.
We're good. Okay.
All right.
Sorry about any confusion. Okay.
All right. So what we're looking at actually here is an annotated illustration for MoneyGuard, and this is MoneyGuard 2. So it's actually the newest solution that we have for long-term care protection at Lincoln. Again, a hybrid product, and all focused on long-term care, death benefit, and return of premium. So when a client gets an illustration, essentially this is what it's going to look like. We just pulled out one page of the illustration so we can take a look at some of the benefits that are involved. But we're going to set up a little bit of a case study. A particular client that we have in mind here that'd be great for MoneyGuard And this individual, his name's Stan, male, age 55. So Stan's actually married, has 2 adult kids, and he's starting to focus on buttoning up basically his retirement plan. Now, even though his retirement's going to be a little bit farther away, about 10 years, still looking into a guaranteed solution for long-term care if he does need it. So because of his success at work, he actually has this healthy annual bonus that he gets every year. Now, that regular additional income is something that Stan doesn't necessarily need. So what we can actually do is reposition a part or all of that annual bonus into a flex pay for MoneyGuard. One of the advantages for MoneyGuard is that you can do a single premium, so a reposition one time, so they only write one check, and then the policy is set for them, or they can actually pay over time. Right now, the majority of our clients are actually looking to pay over time because that premium is a little bit lower, and they still get the guaranteed long-term care and death benefit as they pay into it. On top of that, with MoneyGuard, you have a lot of different features that will help increase the death benefit. One of them is that we don't have a smoker status on MoneyGuard, so essentially smokers get the same rates as non-smokers, which is a big improvement from some of our past policies. Also, you do have a couple of discounts, which we'll get into in just a sec, and of course inflation options, either a 3% compound or a 5% compound to help keep up with the potential gap in that retirement planning that someone might have. So if we look at MoneyGuard 2 for Stan, we're taking a look here again, 55-year-old male. We put in value client, probably the first time that we're showing Stan this illustration. And we are putting on the couple discount because you remember he's married, has 2 adult children, so something else to consider because he might want to pass on that death benefit to those 2 kids. But in this annotated illustration, we have each part of the illustration numbered, giving us a little bit more information about what each benefit. And so the first one, we're looking at a couple discount. That's number 1 and boxed in there in green. Now, if we scroll down, we can see what that really means for Stan. And this couple discount, essentially what it does, it increases their long-term care number anywhere from 3% or 10%, depending on their age and gender, for Lincoln MoneyGuard 2, just because he's married. And that's basically defined by their state. So obviously they're married, they'll get this discount. To long-term care is probably a better way to describe it. Or
I'm going to ask you a question.
As well.
Right. I was going to say, you could be a domestic partner, correct?
Oh, yes, Alana, yes, that's correct.
Okay. Yeah, this is huge that if only one person, especially if it's a second marriage, if only one person, if they have not already taken care of their long-term care planning, they still get a discount even if the other one is not applying. So that's huge. That's really great.
It really is. It's a huge benefit. So they both can apply and they can get that increase to the long-term care, or just one has to apply and that's fine. Regardless if they're male or female, they'll be able to get that increase to the long-term care. So it's a good question to ask, if they are married. Again, yeah, great strategy too for second marriage. If we look at the number 2, we're looking at the different columns here down in the annotated illustration. Number 2 actually talks about their long-term care total benefit. And this is interesting because Stan's 55, but we're still wanting to put on inflation, and they have that option. So since he's young and healthy, one of the best things to consider, especially when looking at MoneyGuard, is the underwriting. So with MoneyGuard, we have the streamlined application process or streamlined underwriting. So there's no medical records that we have to review. So it's very, very easy for Stan. All he has to do is talk to a registered nurse on the phone. And that can be done at nights, at his leisure, after work, whatever it might be. And everything that's said into this phone call, which is it can be less than 45 minutes long, really just goes into the decision. With MoneyGuard, there's no ratings, so it's all pass or fail. That's how it works. So there's a few things we do want you to consider when looking at this underwriting. One is to do pre-qualification. I know BackNine can help you out with that. And that's just looking at the different conditions that a client has And we want to be able to pre-qualify them, because if there's anything there that might knock them out for MoneyGuard, for example, like COPD or a severe like heart disease, then they wouldn't be able to be eligible. So they probably don't want to even go through the process at all. But after you do the pre-qualification, get all the needed information you need, we also have Stan fill out what's called a PHI worksheet. The PHI worksheet, about 3 pages long, and essentially they just put their medical history on there. So basically past conditions, the last time they visited the doctor, beneficiary information, the medications they're taking, things like that. And that's essentially how they have all the answers to the phone call right there. So essentially the nurse will go through that sheet with them, and they'll have all their answers easy. So Stan's not, looking through medicine cabinets or distracted trying to gather together medical information while on the phone. So it makes it go a lot shorter and a lot easier, and obviously more accurate as well. But it's a lot easier process than traditional long-term care, for example, or full underwriting, because all they're doing is this phone call. But with these benefits, we're putting on 3% inflation protection. We put this on the plan, and you can see year after year how those benefits increase. At any time that they need long-term care, that's the number that we're going to start pulling from. And again, that's going to be all tax-free reimbursements for MoneyGuard. The good thing about this inflation as well is that it is attached to the international benefits if they do go abroad. And also, if they go on claim, whether they go on claim or go off claim, it's still going to grow while they're on claim. So it won't stop, and they'll get a little bit extra bang for their buck as well, even if they're on claim, and perhaps if they go off claim, because they get better. So it gives them a lot more benefit with their money.
I'm going to interrupt for 1 second, because I do have a question. I was just talking to somebody yesterday that was concerned about international coverage, and with the traditional long-term care, when it's reimbursement, there are severe limitations, if any, opportunity to use reimbursement with traditional long-term care out of the country. So what is MoneyGuard? Are there stipulations on the percentage? How does MoneyGuard work if you're out of the country?
Oh, that's a good question. So essentially the total long-term care benefit is made up of 2 pools of money. One is the death benefit. So essentially when they start using long-term care for MoneyGuard, they actually draw down from not only their long-term care bucket, but their death benefit bucket as well, dollar for dollar. And then the second bucket is just pure long-term care dollars that's attached to their policy, or in other words, an extension of benefits. So if they go abroad, essentially they only have access to the death benefit number, but they can take that out based on the monthly maximum every month until that's depleted. And it's only for nursing home or facility care.
Okay, and there's a 0-day wait. Are you going to address one of the beauties of MoneyGuard is the built-in 0-day wait for in-home care? Are you going to address that?
Mm-hmm. Yeah, that's actually a very big benefit. Yeah,
it's huge.
Different than traditional. Yeah, it really is, because you have the 0-day for not only nursing home but in-home care or home health care. And what we've seen is that the majority of people go on claim at home first, and they probably stay there if they can. So it's good to know with MoneyGuard they have that 0-day wait for any sort of service that they require.
Yeah, that you don't find that anyplace else, the 0-day wait for facilities. So that's an amazing feature.
A very, very big feature. So I like to talk about that quite a bit. So I appreciate you bringing that up. But just another benefit for MoneyGuard, that 0-day wait feature. If we move on to number 3 here, this is our planned premium area, boxing in red. This is obviously just showing that Stan can actually pay over 10 years. This is our maximum length of period that a client can pay over time. So they can, again, do that single pay. They can pay over 2 years, 3 years, all the way up to 10 years. It really depends on where the asset or where the money's coming from. But in this case, we're using the maximum length of time, 10 years, for a total of $100,000. Now, Alana brought up about the return of premium earlier. If we look at number 4, boxing in orange, we actually show you that they have an option for return of premium with MoneyGuard. They can actually apply for a MoneyGuard product where they get back 80% of what they put in, or they can elect to get back up to 100% after 5 years. So they have their option for more liquidity, or they can choose this 80% option, which is what Stan chose in this example, mainly because it's going to help increase his long-term care number. So if the client chooses 80% option, they get more long-term care, but they can obviously still have an option with MoneyGuard where they get back 100% what they put into it after 5 years with a 100% vested ROP option. So just keep in mind they have two choices with MoneyGuard, 100% option and an 80% option. Majority of clients do go with the 80% option because it gives them, well, more long-term care, and that's usually the name of the game with our solution. Okay, so just a couple more areas to cover on the illustration. Still looking at the ledger page, but right now we're extending out the age of the policy. So it obviously started out when he was 55. The next page is going into when he's age 80 or over. All the benefits, again, still guaranteed. You can see that at the top of the page. But if we look at option 5 here, boxing in green, we're looking at, again, the total long-term care benefit. This is a good area to target when looking at the illustration, what benefit they're getting at age 80, mainly because that's closer to the age of, average age of going on claim. Right now, I believe it's actually 82, but 80 is a nice round number. And you can see that even though they've started out by putting $10,000 today, with inflation, it's going to go over time and get closer to $900,000 for long-term care reimbursements, again, all tax-free. For number 6, they're boxed in blue. We're actually looking at, again, the long-term care benefit, but this is the monthly maximum number that they're going to receive. So whenever they start using long-term care, they're actually pulling, they can pull out up to this monthly maximum. If we jump to age 85, at least the area that the annotated illustration is targeting here, Stan's getting a reimbursement amount every month of $13,427. The total benefit amounts to over $1 million in coverage, giving Stan obviously a lot more flexibility to use these other assets and obviously focus MoneyGuard on paying for his long-term care. If we look at number 7 on this page, boxed in red, we're looking at the death benefit column. So if Stan does pass away at any point, he's going to be getting a death benefit of $132,763. Like any other life insurance, that's tax-free, and it's over 20% greater than the premium that he put into the policy. So again, he's getting back a return on this policy, whether he needs it for long-term care or he doesn't. Again, the focus is long-term care, but we're still giving him the guaranteed tax advantage return from the policy, despite what happens in the future. And then last but not least, the best part about the illustration is number 8 here, boxed in orange, and it talks about the IRR and the policy, or the internal rate of return. I like individuals to go over this because a lot of clients have questions and they say, I think MoneyGuard's a great solution, but what's the return? What am I getting back from this? How fast is my cash growing? Well, really the idea is that the return on MoneyGuard is going to be that long-term care money that you get, or the death benefit, really what comes out of the policy in there for benefit, if you need it because you get sick or because you pass away, or both. Because with MoneyGuard, you do have a residual death benefit. So even if you use the entire policy for long-term care and exhausted everything, remember we start draining that death benefit first, dollar for dollar, and you use everything for long-term care, you still have a residual death benefit that's built in there, which is essentially 5% of the original death benefit, or $10,000, whichever is lesser. So there is still something in there to give back to the client's beneficiary, maybe a burial policy or something like that.
Lee, can I interrupt for 1 second? We do have a question about since it's reimbursement and you have let's address the fact that you have a long-term care benefit pool. And the question is it based on the monthly benefit at the time of claim, and for how many years? Is it 6 years? Well, can you address the fact that it's a pool of money, and if you if you don't use a full monthly benefit, how that the effect it has on the 6 years of long-term care.
Oh, sure. So most of our policies are a 6-year minimum duration policy. It can really be anywhere as small as a 2-year minimum duration to a 7-year minimum duration. Most of our policies are 6 years, though, which is probably why the question came around there. But essentially, what that means is that if the client uses the monthly maximum every month for six years straight, they're going to go through their entire long-term care bucket. But it is a pool, like Alana said, so if they use, let's say, like half of their monthly maximum every month, the policy will last for 12 years instead of 6. But you can go on and off plan with MoneyGuard, so really it's a pool that you're pulling from every month. As long as there's still money there, you can use it. But the minimum amount of time that you can run through it is 6 years.
And another question which we should address is that the 3% compound is growth on the LTC benefit. It is not growth on the death benefit should you never need the long-term care, correct?
That is correct. Yep. So you can see the long-term care number growing on the illustration, but that death benefit number is guaranteed for you, and we see it isn't growing for staying here. But obviously still gets that tax-free benefit if he does pass away. All right, and then the last point I wanted to touch on here, and then we'll open it up just in case there are any other questions, is again that IRR column, so internal rate of return. This is great to go over with the client, and the best way to read this column, if we look at the annotated note here for number 8, at age 80, he gets an internal rate of return of 9.5%. So what that means is that if Stan's comparing this to like another, I would say, alternative asset, like a CD, for example, he's going to have to find a CD that's going to give him 9.5% in return every year for the next 26 years until he gets to age 80, of course. So if you're looking at another investment, or maybe if they want to invest in the stock market, that's the type of rate of return that they have to see year after year to compare it with MoneyGuard. So that 9.5% for the long-term care is quite high, and it's something that a client should know because it makes better terms of what they're getting out of the policy for MoneyGuard too. But that's basically the annotated illustration for MoneyGuard 2, and then the time that we had today, we went over a lot of what MoneyGuard is all about for a client. One thing to remember is that you all get guaranteed benefits in the policy. So everything we saw in the illustration is set in stone. Depending on whenever they need it during the life that they have, those are the guaranteed benefits they get for a long-term care or a death benefit. And of course, there's still that option for some or all their return of premium. On top of that, a great benefit with MoneyGuard is that care coordination. We have concierge care coordination, which obviously will help them with interviewing nursing homes, getting discounted rates for long-term care, going through the claims process, and also finding a care provider as well. A lot of things that are very time-consuming and can be confusing for a lot of clients when long-term care does arise. So that care coordination will pretty much do everything for you. The best thing about it is that it's a free service, and also you can use it before going on claim. So a lot of clients do use their care coordination with MoneyGuard before going on claim just to get more information about long-term care in their area, or if they're going to move, what might be the best place to move to, and they can keep up to date on the changing services for long-term care and the evolving network that long-term care has going on. So again, just another benefit that they have with this MoneyGuard policy, making sure that they can protect their portfolio, but again, staying up to date on long-term care needs that might arise. But that's everything I want to go over. So I'll actually pass it back over to Alana and Jonathan to take it from here.
So Lee, I do have a question, and it's a great question. The question is minimum premium. So we haven't discussed yet that you can pay. You have options. You have single pay, and then you have 3, 5, 7, and 10. Am I correct?
Yep. Yeah, you have 3, 5, 7, and 10, and actually you have more options than that. You can do anything in between 1 and 10, so they can even do like a 6
okay,
day
that
or a
opens
9
up.
day, something like that.
Okay, that's great.
Yeah.
So if you were going to, so what is the minimum premium? Does it get calculated? Let's say, like, is a single pay the minimum is $30K?
It can be, depending on the client. Really, the minimum, and that's actually a good question, because the minimum is based on the death benefit. So we just have to create a death benefit of $50,000.
Okay,
so if you,
all right.
Yeah, so you put in $30K, it might get to $50,000, depending on the age
So you need
of a client.
Got it. So you need a $50,000 death benefit. So we can start from that point and work backwards to see what it offers, and then based on the age of the individual, so it doesn't mess.
Yep.
So everybody, it's not cut and dry. There's variables based on if you want inflation protection, how many years. That's my job. My job is to help you leverage your client's money in the best way possible, and it takes some configuration. We play with the software a little bit. The whole idea is to avoid a MEC, so that way you are able to use the long-term care benefit. So there is no straight answer. I play with the software for quite a bit, and then I come up with your better options. Yeah, Lee?
Excellent. Yep. No, that's
okay. Yeah.
Oh.
No, that's what I was going to just say. It's like we play around with the inflation protection. We play around with the amount of premium we have available, and then I work hard to try to leverage with your client's best interests. So thank you very much, Lee, and I'm available for everyone if you want to give me a call. Maybe you have some specific clients you're thinking in mind, and of course we will follow up on this presentation. We will email all of you. We have materials that Lee has presented to us, and we will also follow up sending you those materials. Okay, thank you for spending this hour with us, and looking forward to working with you. Take care, everyone.
Oh, thank you. Have a great day, everyone.
Thanks, Lee.